welcome back to the REI Hot Seat. I've got Nick Wright on the show. This is going to be a little bit different today because normally we are going over deals on the market, like in terms of real estate. This is a little bit different because we're actually talking about equity, but real estate related. So, Nick, why don't we just start things off? I'll introduce you. You're a licensed EMD, if I understand correctly.
Yes, that's correct.
So, exempt market dealer. And basically dealing in Canada, but I think you have the ability to operate internationally, if I'm not mistaken.
Why don't I give it a brief intro?
Yeah. Well, first off, thank you for doing this. I really appreciate it. You can explain it much better than I, so I'm going to let you take it away.
Okay. Yeah. Thanks for having me. Looking forward to our discussion today. So my name is Nick Wright. I'm the head of Startly Inc., which is a licensed exempt market dealer in British Columbia, Alberta, and Ontario. And now for those who don't know, an exempt market dealer is an entity that's been licensed by a securities regulator to trade in exempt securities, those securities that aren't publicly traded. And one common example of that are real estate investment funds. So real estate investment trusts and also limited partnerships, which are very popular and one of the main exempt market products that people have gotten into and have profited from by investing in real estate.
Yeah, so to just build on that, there are publicly traded REITs, like real estate investment trusts, but you also deal in at least one not publicly traded REIT. Is that correct?
Correct. And one of the things that appeals to some people about the private exempt market is that the funds can be a little bit different. They can be smaller, they can be more nimble and take advantage of opportunities that the larger public funds may not be able to.
Yeah, and maybe you could just expand on that a little bit, because obviously, like, people have heard stories of, like hedge funds and whatever that do these crazy good returns, but not everybody has access to them. They're more sort of privately accessed, or the average Canadian wouldn't necessarily know how to access them. Is that sort of the nature of this, that people just don't necessarily know about it? So it's typically a bottleneck of information that people don't know that these options are available.
So to describe it, I can give a bit of background on the laws in Canada around raising money. And the general rules that if you're raising money, you have to have what's called a prospectus, which is a very lengthy document that provides disclosure. It's quite expensive to put together. There's a lot of fees involved. And then for companies that either want to raise funds privately, or it doesn't make financial sense to do that kind of expensive prospectus offering, there are what's called exemptions to the prospectus requirement. And there are a number of different exemptions, but securities that aren't trading with a prospectus, this very lengthy, complex, and often costly document, are what's called exempt securities, or the exempt market. So it makes up a lot of private investments. It also makes up investments that are having people invest based on various exemptions. So one common one that people might be familiar with is what's called the accredited investor exemption. And that says that people who are above a certain wealth threshold are able to invest in these private securities, whereas people below that wealth threshold may not be, or may not be able to invest the same amounts. And a common private offering is an accredited investor only offering that says only people above a certain wealth threshold, which broadly speaking is over $200,000 a year in income, over 1 million in financial assets, or over 5 million in total assets. So people who meet that wealth threshold can invest in this private securities marketplace.
Yeah.
There's also another exemption, which is relatively new, the offering memorandum exemption in Ontario. And that allows what's called eligible investors, which is more of a middle class threshold to invest either up to $30,000 a year without the recommendation of a dealer or exempt market dealer, or up to $100,000 with that exemption. And that relies on what's called the offering memorandum exemption, which is like a mini prospectus. So it gets a little bit complex, but broadly speaking. So Startly is a EMD registered in Ontario, Alberta, and BC. We're currently working with District REIT and Valor Partners, which is a group of companies that invests in real estate in Southwestern Ontario. District REIT has been around for some time. It has established a portfolio of real estate assets, residential, commercial, industrial in Southwestern Ontario that has a stable revenue from rentals
and also has steady capital appreciation. And that's a REIT, a real estate investment trust, relying on the offering memorandum exemption, which means not just accredited investors can invest, but also so-called eligible investors, people who don't meet that threshold. So it's really an investment that's available to everyone who fits the suitability criteria. And it's also an investment that people can invest through RRSPs, TFSAs, LIRAs, other registered accounts. So that's a good investment opportunity for those interested in gaining exposure to real estate in Southwestern Ontario. There's also 4 relatively new limited partnership funds that are quite exciting. The idea is that they capture different stages of the real estate development process. The first and so far most popular is being the acquisition fund. And that's a limited partnership fund, like I say, accredited investors only, with a $100,000 minimum investment that focuses on land acquisition, zoning, and preparing property for investment and development. The other is the construction fund, which focuses on the actual construction of buildings. There's a prime properties fund that focuses more on the actual renovation management of buildings. And then there's an equity fund, which unlike the others is equity rather than debt. So that's higher risk, but higher potential return. And the first 3 are all debt-based, meaning that there's steady cash flows. So it can also act as an income investment property as well.
Okay, so I'm going to give a little bit of a background and then I'm going to ask you some questions. So first off, full disclosure, District REIT has come on as a sponsor for me. That's my mother-in-law. She's like the trustee of that. I don't know if you say she founded the REIT. I guess we'll say that. And then several of these would all be the funds within their group of companies, Valor, ProFunds, District REIT. So that's the connection there. That's how we got connected. Just wanted to clarify that for everybody. So that's sort of family, like Jacob, Carmen's son is normally on this show. So it's we're all into real estate anyways. Okay. So Nick, like one of the big things like I wanted to bring you on here for is like a lot of people have RSPs, registered funds, and they're just in your typical mutual funds with institutions and stuff. And we all know how disappointing a lot of people find that to be. For context, is it generally easy for people to use registered funds to invest in something like this?
So part of the appeal to these funds is that people who want to invest in real estate, but want to invest in an amount less than purchasing a property themselves, which can be very high, and or want the ease of not having to manage a property, can invest in these sorts of investments, gain exposure to the Canadian and Ontario real estate market, but without having to incur the expense and work and have the expertise required to do the actual management. So it's a great solution for people who want exposure to real estate, but don't have the willingness or expertise or ability or desire to actually go out and buy properties directly.
I think that's going to be a certain portion of my audience. I think that there's also some people who have, like, they just have those RSPs. And my understanding is that I cannot take something that I have in my own RSP and use that as a down payment for my property directly, right? I can't lend to myself. It's got to be arm's length if I'm going to do it. So it seems like if I want to own real estate with my RSP, this is kind of the only way to do it. Is that true? Or, and that would qualify, I guess, in the REIT example, because you're technically owning equity in a real estate portfolio. Maybe not in the funds per se, but do I have that assessment correct?
Yeah, for sure. It's a way to invest via a registered account that wouldn't otherwise be available if you're, for example, buying a rental property and managing it yourself.
Yeah, the only way you can do it is to take it out of your RSP if you wanted to use your money to buy real estate otherwise, which if you don't want to take that tax hit, this is, I guess, the other alternative. That's basically a fair assessment?
Yep. And some people who also have rental properties and other kind of more hands-on real estate investments will then also invest their RSPs or registered accounts in these sorts of investments. Yeah. Now you want to be thoughtful about the amount of concentration you put into real estate. The idea is to have a diversified portfolio that has some balance to reduce risk. But that's definitely an option for people who want to invest in real estate via registered accounts.
Okay, so starting from the top, you mentioned that some of these funds are debt-based, and I imagine the activity is going to dictate the return they pay. So how does that work? They wouldn't be buying an equity certificate. They would be buying a unit of debt in these funds.
Correct. So the investors invest money into the limited partnership. In exchange, they receive a unit in the limited partnership. And for the three debt-based funds, the LP then loans the money to various projects, of which the group of companies has many on the go, and then can immediately start receiving monthly distributions. So it can work both ways. For people who want income, they can opt to get the distributions in cash to their account each month. Or if you're more interested in capital appreciation, then you can sign in for what's called the DRIP, or the reinvestment plan, where the money that would have been paid out as a distribution instead gets invested back into units. And there's a bonus that ranges from 2 to 5%, depending on the fund, for people who sign up for this DRIP reinvestment program.
And the reinvestment, is that like, how often does that happen? Is that a monthly reinvestment, or is it annual?
It's a monthly basis. Okay. So for the three debt funds, there are monthly distributions based on the amount that you've invested. And you can either receive that in cash into your bank account, or conversely, if you sign up for the DRIP, you get this bonus. So there's an incentive to reinvest the money back into the fund.
Okay,
yeah, on a monthly basis, just like the cash distributions.
Yeah, that's interesting for people who don't need the monthly payout. Okay, and are you able to share? Like, obviously, this is a very specific, and I just want to qualify this. This is a very specific offering that you just happen to carry. So, for anyone looking for the context, Nick is sharing sort of his package that he is able to kind of work with right now. But out of the ones that you've been dealing with, what type of returns have they been able to do for the ones that have a track record that you can share?
So again, the website is starttheportal.ca. You can check out all the different investments. But District REIT has done particularly well in the last couple of years, in part because of the good management and careful selection of the portfolio, and also in part because real estate has also done well. And that is currently, as of the time of recording, paying out an 8% per annum cash distribution paid out monthly. But then in addition to that 8%, there's also, and that can vary over time, there's a target return. That's the current return that's being paid out. But in addition to that, there's also the capital appreciation on the properties as the prices of real estate have been going up, the value of the units and the properties have been increasing. And then if you opt for the DRIP reinvestment, you get an additional boost, in the case of REIT, 2%. So the combination of the distributions, the DRIP bonus, and then also the capital appreciation means that you can have returns much higher than the actual amount being paid out on a monthly basis. So one way to think about it is that it's a portfolio of properties. The properties have their rents that are paying out, so the tenants pay their rent each month. And then there's also the land that goes up in value over time, or has been for quite a few years now.
And this is a concept that my audience will be super familiar with, because this is what we do with like individual properties when we buy them. So this is more just doing it with a portfolio. Although I don't think a lot of people are getting an 8% cash on cash, not in Ontario, generally speaking. That's a little harder to achieve. What would you say, like, do you have a ballpark of what it did last year in the example of District REIT for an overall return?
If I recall, it was around 18%, the return last year. But that was due to a number of different factors, like the way the fund was accounted for, the real estate market doing well, the skill of the management, the curation of the portfolio. So it's important that I not forecast future returns, but it has been doing very well as of late.
Yeah. Okay. Yeah, I just wanted to get that for context. And then on the debt side of things, and I think this is probably super new for a lot of my audience, so I just feel like it's worth digging into. Like, I knew about REITs, but I was never really that familiar with funds. In more recent years, I've been looking at how to start my own fund. Haven't got there yet. But on the debt-based fund sides, are they just paying out an interest rate, and how does that work? Like, this is the return as of today, and will that stay? And then a follow-up question is, how long are people committing to? Is it redeemable, and what time? Yeah,
so in the REIT, because it's a portfolio of income producing properties, the money is coming from rental payments and capital appreciation. Whereas the new debt funds are a little bit different because they're not REITs or limited partnerships, so the structure is slightly different. But also because they're debt-based funds, as soon as the money is invested, it's loaned out to existing projects that are part of this group of companies that has a lot of projects on the go, has a long track record in the industry. And then these projects are able to start paying interest on those loans right away. So as soon as you invest, you can start receiving these cash distributions. And so long as everything goes according to plan, it's very stable cash flow and regular payouts. Now, if there was a major real estate market correction or change or something dramatic happened with the economy, those returns aren't guaranteed. But because it's debt rather than equity, it would rank higher to equity claims. So it's more secure than an equity investment.
Okay. In terms of like
there's an agreement in place in terms of the amount. So as long as there is not a default on the agreements, then it's a steady cash flow.
Okay. And what have they been like, or like, do you have an example that you can share of what's been advertised as a rate?
Yeah, so it ranges from 11% to up to, for the equity fund, 25% targeted returns. And then, as I said, the distributions can start immediately upon investment. They're paid out on a monthly basis, so the following period from investment. And generally to date, the targeted returns have been met within the prescribed range. And it's part of the same group of companies with a long track record. So even though these funds are relatively new, it's part of this Valor group of companies that has been around a long time, has built up a very solid reputation. And from my experience dealing with investors on a daily basis, people have a lot of faith in the funds and the group of companies and excitement about the product. So I think that speaks well for the investments.
Yeah, and interesting point I wanted to throw out there is actually one of the properties in District REIT I actually managed to build on. I was the project manager on the build for one of the London properties. At least one that I know of. There's another one that might be a candidate for it. I'm not sure, but so yeah, I just wanted to kind of go into that. What time frame? Like if somebody wanted to invest in one of these debt funds, and again, I know qualifying this strictly speaking for these specific offerings, how like if they wanted to get their money out in a certain time frame, is that an option? Like what are they committing to?
So it's slightly different for each fund, but the debt-based funds, the limited partnerships, generally there's a 2-year minimum investment period. So you'd be promising to investor funds for 2 years, and then thereafter there's the ability to redeem, and that's done on a quarterly basis. And if there are caveats in place, so if everyone wanted to redeem in the same quarter, for example, then it would be paid out on a pro rata basis, because obviously the fund is investing in projects, it's not keeping all the money in cash. But there are redemption rights for the funds, so that there's a degree of liquidity after that 24-month initial investment period.
Okay, and then on the equity side, I think even District REIT, I've heard that there's a redemption there. Is that the case? Yep,
District REIT as well. You can redeem, and there's not a minimum investment period, but practically speaking, it would be a minimum of about 6 months because it's quarterly. You'd invest, and then if you want to redeem, there'd be a period of time until the next quarterly redemption period comes up. So yeah, for District REIT, it's redeemable. There's a minimum investment of only $10,000, so low minimum investment. It's open to eligible investors who are not accredited investors, and that's generally people who have either $400,000 in assets or make over $75,000 a year, and then even people below that can invest up to $10,000. And then because you're eligible to invest via registered account like RRSP, TFSA, it's a fund that's very versatile. You can also use it as an income fund if you want the cash distributions. If you want capital appreciation, you can sign up for DRIP. So there's something for everyone with District REIT.
When you say drip,
and
can you just
available.
refresh? Could you just refresh what drip means? Is that where it's building up the asset instead? Like it's just going into more
that's
units?
instead of receiving the monthly cash distributions to your bank account, instead you reinvest in units.
Okay.
So in a way, it's a fund that is available to most people, with low minimum, eligible investors permitted.
And the other funds are not that
account.
low. The other funds are not that low. Like 10 grand is
the other funds is around 100,000, very slightly fund to fund, but most of them it's 100,000 minimum and accredited investor only.
Okay, so the ones for people who are looking just for the small amount would pretty much be district, and then I don't know if there's any others, or that's kind of their starting point.
Yeah, for so-called eligible investors, people below that accredited investor threshold, or people who want to invest in a registered account, then district REIT is the investment option that Startley offers that we'd recommend.
Okay. Is there anything else? I think we really covered on the basics. I really just wanted to get the nuts and bolts out there as a concept to kind of show what this is. Obviously, your offerings are specific to the Valor Pro Funds district kind of group of companies. Anything else worth noting here that we didn't already cover?
Yeah, I think to summarize, you can check the website at startleyportal.ca to see the particulars of each investment. If you want to learn more, feel free to send me an email. It's nick@startleyportal.ca. I can provide more fuller documentation. But in summary, it's a great way to invest in real estate, to reduce your risk in comparison to investing in a particular property, and also to invest in registered funds without having to have the time and effort of actually managing properties. So it's a great way to gain exposure in the real estate market that, as we all know, has done very, very well in past years.
Yeah, I mean, from an observation standpoint, I think a lot of my following have a certain amount of their funds that are kind of dedicated for stuff like this, more passive stuff. So it's great to have, a little more information on this and what's possible on your end. So I appreciate the talk. Just, general disclaimer to everyone watching. I can't give advice in any of this stuff. Obviously, you need to talk to a qualified financial advisor. In this case, it's likely going to be an EMD before making this kind of decision. Nick just happens to be one of them. So Nick's shared his information. Really appreciate you doing this call. And I guess we'll wrap it up at that, Nick. And looking forward to staying in touch. And it's certainly nice to meet you.
Thank you. And part of the process, if you get in touch, is that we'll go through a full assessment and suitability assessment of whether or not these investments are appropriate for you. But as I say, happy to speak. And it's Nick, N-I-C-K, at startleyportal.ca.
Perfect. All right. Well, thanks so much, Nick. Really appreciate you taking the time to do this.